Hey everyone. Today I want to chat with you about choosing an ETF, and I'm going to do a comparison on some ETFs that track different stocks within the S&P 500, and I want to see their correlation because I think there's a lot of them out there that are very, very similar. Welcome back to Drawbridge Finance. My name is Levi Woods. This is an opinion channel about money, and I'm not offering financial advice of any sort. Now today, I'm going to jump right into this. I'm basically going to look at the SPY in different forms of ETFs, some that are a little bit cheaper, and I want to see what their relative returns are comparative to one another. Okay, so the very first thing we're going to look at is the SPY. Now, for those of you who don't know, the SPY is an ETF. Now, this stands for Exchange Traded Fund. Now, what these are they're basically computer programs that track all of the different stocks minute by minute throughout the trading day, and they effectively trade for us. Now, the advantage of using an ETF is that they have incredibly low fees compared to mutual funds. My brother and I were just having this conversation the other day, and we were talking about the fees, and the mutual fund advisors will tell you that they offer really super low fees, like 1.5%. Well, 1.5% is extremely high comparatively to the ETF fees. So if we look at this one, the SPY, the expense ratio is 0.09%. Now that is minuscule, and it's because it's a computer doing all the trading. Now, why would you want to invest in the SPY? Well, it's made up of 500 companies that are based in America. They're registered in America. You've actually got a little bit of global exposure there to different countries. So it's actually a pretty well-rounded, diverse group of investments. And the reason is you can see it in the chart. Let me just pull up this full screen chart and let's just look at what it has done over time. If we look at this going back to 1993 when it started, it's just on a tear. I mean, the thing makes 9.8% on average since inception. Now, I've done videos on this before, but today I want to talk about other funds that other people offer. And the first one that comes to mind, of course, is Vanguard. Today, we're going to look at a couple of different ETFs. We're going to look at VOO. We're going to look at VFIAX, VTI, we're going to look at VHYAX, and we're going to look at VDIGX. Now, I haven't picked these for any particular reason, but I just want to show you guys how they function so you can see that they're relatively similar. First thing we're going to look at is Yahoo Finance. So let's just pull up one of these. We're going to look at the VOO. Remember, you can just search in the search bar. So type in VOO and it comes up. Here it is, the Vanguard S&P 500 ETF. You can look at the profile of it and you can see what it is. The investment seeks to track the performance of the benchmark index that measures the investment return of large cap stocks. The fund employs an indexing investment approach designed to track the performance of the Standard & Poor's 500 index, a widely recognized benchmark of the U.S. stock market performance that is dominated by stocks of large U.S. companies. The advisor attempts to replicate the target index by investing all or substantially all of its assets in the stocks that make up the index, holding each stock in approximately the same proportion as its weighting in the index. So basically what it's trying to do is it's trying to track this S&P 500, which is what we see on finance reports all of the time is the S&P 500. So today it was up 2.29%. So that's what the profile is. What I want to look at is what the holdings are so you can kind of get an idea of how this breaks down. Let's just look at the sector weightings because I think that that's actually the easiest way to compare these. So basic materials, that's going to be 2%. Consumer cyclical, 9.65%. Financial services, 13.7%. Real estate, 3%. Consumer defensive, 8%. Healthcare, 15%. Utilities, 3.59%. You get the drift. We can see this snapshot. Now let's look at one of the other ones. Let's look at VFIAX. Now this is very, very similar. Let's just look at the holdings. Basic materials, 2%. Consumer cyclical, 9%. Financial service, 13%. Real estate, 3%. Consumer defense, 8.17%. Are these numbers looking pretty similar? Now let's look at VTI, 2%, 9%, 13%. When we start to look at a cross-section of what these funds actually have in them, we can see that they're all relatively similar. So it makes me think, well, if they are similar in their holdings, they should be similar in their performance. So let's do a comparison. I'm going to show you a trick with Yahoo Finance, which I think is great, and it allows us to do a comparison between different stocks or ETFs. So I'm just going to pull up VOO. And I'm gonna go to the chart. Let's just look at a 5-year chart. Now you guys probably recognize this chart. I've done videos on this many times. You know exactly how I have it set up, but I'm gonna have to dismantle this a little bit in order to show you these comparisons. So I'm gonna change from candles to lines, and I'm gonna delete all my moving averages. If you don't know how to set this up, I have a video specifically on how to set up these moving averages so that it shows exactly what I'm looking at. If you're not familiar with Yahoo Finance, this is probably what your chart looks like by default. So here it is, this purple line. And right up here on the left-hand side, you can see there's this comparison. So we can just click on plus comparison, and we can just type in what we want. So we want to look at the VFIAX. And we're gonna choose blue, and we're gonna click save. Well, look at that. Would you believe it? It is identical. It basically covered up the purple line, except for a little spot here and a little spot here. Not shocked at all. VOO and VFIAX are computer programs that are trying to track the same thing. So why would their performance be any difference? The only difference between the two is the price. There's barely any difference. If we look at it, the VOO closed today at 256.47 and the VFIAX closed at 252.83. This is something that you need to look at. There's 32% return and a 29% return. So although the lines look very, very similar, there is a slight difference, and I'll show you where that difference is. So I'm gonna go back to VOO, and I'm gonna show you the expense ratio right here is 0.03%. Now, if we look at VFIAX, and we look at its summary, its expense ratio is 0.04%. And that 0.01% makes the difference. It makes the difference between a 32% return and a 29% return. But let's track a couple of others. Now we're looking at the 5-year. I'm just gonna click on comparison again, and we're gonna type in a few others. So we're gonna look at VHYAX, and we're gonna save that. It's gonna be a pink line. VDIGX, 13% return. Now we're starting to see some difference of returns here. So they're very, very similar, but there's some slight differences. And we can put on VTI. Now here it is, here's the snapshot view, and we can see that, remember, the blue and purple line are hidden. Then we have this yellow line, which looks like that's the VTI is kind of next. And then we have the pink line, which is the VHYAX, and then down at the bottom, we have the VDIGX. I want to just look at these expense ratios and see if the expense ratio has anything to do with this. So let's take a look. The VTI, let's look at that expense ratio. And here's the expense ratio, 0.03, so very, very low. Then if we look at the YAX, we can see an expense ratio of 0.08, so almost double what the other ones were. And again, if we look back at that chart, we can see that that's reflected in there. So that's the pink line, and that's the one with the 0.08% MER. Now let's finally look at VDIGX. And here we go, expense ratio of 0.22%. Now, 0.22% is still extremely low, but it factors into these, and we can see that this return of 13.6% is actually a far cry from this 32%. Now, that is in part due to the holdings that it has, and it's also in part due to this extra high MER. Now, interestingly enough, when I actually tried to look up the VX, what is it? The VD. Now, believe it or not, when I looked up VDIGX on Interactive Brokers, it actually gave me a warning, which was quite funny. It popped up with this. It said, VDIGX Vanguard Dividend Growth Fund, comparable ETFs with lower fees may be available. Now, this is on a 0.2% MER. Now, my brother and I were talking about how his advisor was telling him that a 1.5% MER was good. And my brokerage is telling me that a 0.22% is too high and that I can get cheaper. So I don't know what his broker is smoking. And that's the kind of thing that happens with these brokerages is they're trying to make money, so they're just taking it from you. I mean, you're the consumer, and that's why they're taking it from you, because that's the only way that they can get paid. And that's one of the things that's interesting about how the financial industry works. I mean, I'm not trying to knock traditional brokers, but they do cost us a lot of money, and it's money out of our pockets, and that's why I don't use them anymore, and I can't stand mutual funds. I mean, I'm going to invest in ETFs like this. Now, as a Canadian, there's advantages and disadvantages of buying in Canadian dollars. I personally would just buy the VOO, but I also have a large enough account that that's the one that I would go for. If I was just starting out and I was looking for something a little bit cheaper, if we compare at today's prices, the VDIGX, although it has a higher expense ratio of 0.2%, which is still extremely low, it actually has a really low price point. I can buy more shares with $260 than I can with $260 in the VOO. Now, also as an options trader, you have to think about that as well. Like if you guys are watching this channel and thinking you're inspired about investing and you're not quite at that options trading level yet, and if you're putting money into these ETFs, there's potential that you'll be able to trade options on them like covered calls in the future. So for young investors, I would be looking at starting off with something like the VHYAX and putting money into that because it's a low expense fund and it's only $22 a share. Then as my account grew, I would just transfer those over. And since you can see the correlation, just sell the VHYAX and buy the VOO. I mean, that's kind of how I would swing that. So I would end up with these comparable investments. Now, I'm going to show you guys one other thing just to show you that not all investments just track like this because they don't. Let's look at something that tracks the bond market like TLT. And this is the 20-year Treasury bond. We'll put that as a green line. Totally different trajectory. We can see that it was down and it actually inversely relates often. So what's happened with the market is as it's been selling off and all of these other funds, these 5 funds we're looking at are going down, the bond market was actually going up. Now, historically, bonds don't make a huge amount of money year after year. So there's this old attitude about having a greater number of bonds when you're elderly and you have you need a more stable return. And I totally don't take that approach with investing. I believe that we should just build our accounts to a size that has way more money than we actually require when we're retired. I mean, if I was investing in bonds and they had a low yield, then my money is just going to grow slowly. So I personally would much prefer to have an aggressive stock market ETF like VOO and just hold that for a long time and make twice as much money over the long term. And then when I retire, only have to use half of it. Now, that doesn't mean that I don't keep some assets in cash or cash equivalents, but that's a topic for another video. So if you're interested in that, make sure you hit that subscribe button. Remember, if you enjoyed today's video, to hit that like button because that helps me a ton. And stick around so we can all get rich together. Thanks so much for watching.